about 2.5, 3 months ago that we would want to and need to prepare a presentation like this. So for the last 60 or so days, it's really been us digesting what we know so far, and unpacking an 870-page tax bill has certainly been a fun exercise for us. But because we're a team, we kind of all took our own sections with the hopes of coming together for a webinar like today. So specifically, our goal today is discussed at, or is aimed at discussing the key areas that we think will be impacting our retiree community of clients. We also want to make sure that we address some common misconceptions around Social Security and taxation, and then hopefully provide some good planning insights that can spark the conversation with you. So the flow of today is going to be taxes, Social Security and taxes, and then finally some important healthcare updates regarding things like Medicare, or if you're pre-65 but already retired, the Affordable Care Act. So please ask questions along the way. We are getting questions, so we can see that it's working. Matt and I are going to monitor the chat and the Q&A. We'll try to keep it fun, interactive. Matt, anything else that you want to?
No, great intro, John. We want to make this
it?
fun. This is not the most exciting topic to discuss, so we should want to make sure everyone is finding some level of interest here. We're going to do our best to make sure we integrate in various scenarios. So whether you're an early retiree, you're kind of late in retiree, or you're approaching those years, which wants to see what are some tips and hints and tricks that we're dealing with. And really, I think you're going to see that the common theme here is planning. It's if we can plan, we can hopefully not have any surprises when it comes to retirement.
All right, so important question. Did you figure out what's your favorite tax credit?
No, I didn't. I'm thinking about the next thing to say right now, and I will think of a tax credit in a moment. Goodness gracious. There's a lot of them.
Fair enough. So in the spirit of keeping it fun, we're going to kick it off with just a catch-all slide that's got everything all at once. But we're going to go one by one with this and go in order. So we'll start with the estate tax. This is also known, some of you have referred to this as the death tax, but basically kind of how this works is, if you pass away with an estate above a certain amount, for every dollar that's over that amount, a 40% flat tax is applied to that. So what was set to occur before the tax legislation came through in July was that it was going to revert back to 2017 levels, which were 5 million at the time, adjusted for inflation would have been about 7 million. And in 2025, those numbers are 13.99 million, and they have been increased and extended to 15 million per person. And I believe those have been extended permanently. Matt, is that a fair shake? Did I get that right?
Looks to be. I mean, permanent's only as
good.
Only as good as whoever's in office and whatever the tax legislation is at that time. But yeah, let's call it that.
Okay, fair enough. Do you want to talk about standard deductions for us, Matthew?
Yeah, standard deduction doesn't change. Now, it's going to get confusing when we talk here for a moment because the technical standard deduction has not changed. What we are going to talk about is that very last bottom line there, where's new senior deduction. That's the new deduction here that we're going to spend some time talking about today. But my two parts here, kind of this middle section, standard deduction remains the same. Also, capital gains and dividends. No real changes there from a tax standpoint. Dividends are still going to be considered either qualified or non-qualified, and that really just has to do with how they're taxed. And then capital gains, again, it's depending on which tax bracket you're in determines the capital gains amount. And so again, there's no real change with either one of those items.
Well, let's talk about capital gains for a moment. Just to further explain it for those that most of you probably know this, but there's the long-term capital gains rate in America is either 0, 15%, or 20%. And it's based on where your income falls. And so as Matt shared, there's no changes to long-term capital gains. Actually, in getting a question here in real time, what about short-term capital gains rates? Are those changing, and are those taxed differently, Matt?
No, those have not changed either. Short-term capital gains does not get this preferential rate. They're taxed at your ordinary income rate. So that just depends on what your other income looks like. And it's tacked on as if you had any type of income that comes in, just taxes or income, no preferential treatment. And then just quick definition, a long-term capital gain is a capital gain, a capital asset. In most cases, this is a stock or a fund that we have, it needs to be held for a year and a day. You're short by 1 day there, it's now considered short term, and doesn't get that preferential tax treatment.
365 plus one. That's what I
Plus
always
one.
remember learning back in the day.
Yeah, don't
So
forget that.
can we talk about the SALT deduction? Because I see a lot of, familiar names here on this webinar with us. Many are in the state of Florida, but there are a number of folks here that are not. And this certainly might apply to their situation. Do you mind explaining what this is? So it's state and local taxes, but could
Yeah,
you
you took the
elaborate a
easy
little bit
part
on
away,
what this?
John. Yeah, that was like
Well,
I was going to spend some time on what that
that's
acronym
what
meant, but
I'm the
okay.
host. I get to take the easy ones. You
It's
take
not
the hard
fair.
questions.
State and local taxes, right? So the current low, prior to the change in tax legislation, is you were limited on the first $10,000 of taxes that are paid, and this is only if you itemize. So think of our clients in New York or maybe in California who have not only federal income tax but also have state income tax. Let's say they're also charitably inclined and maybe they have a mortgage. They were, in most situations, going to itemize and not take the standard deduction in previous years. The caveat to that is that they were limited to the first $10,000 of taxes paid. By the way, it's not just state tax that's included in this. Maybe you have a home here in Florida and maybe a second home. Maybe you have a vacation property and you're paying real estate taxes on both, and it totaled to more than 10,000. Or the general sales tax deduction, again, very not used as much these days because the standard deduction has risen so much, but there are some very small circumstances where this might have impacted our clients here in the state of Florida. This has changed though. So this has gone now from 10,000 to up to 40,000. Now, just like with everything else we're going to talk about here today, there's always limitations. And that limitation starts at having an adjusted gross income above a certain threshold. But for most of our clients here, they should benefit, especially those that are out of the state of Florida, should benefit from being able to have an increased set of deductions. And it's going to be compounded even more if they're having a mortgage or they're itemizing. Maybe they have some major health expenses. We have a number of clients that are in maybe an assisted living facility, and a portion of those payments that they're there does count towards their medical deductions, or they're charitably inclined and they give to their favorite 501c3. All of that combined, if that equals more than the standard deduction, allows you to itemize. So this might be a pretty big boost. Again, we're going to see it mostly for our clients that are paying a state tax here, coming up this year.
Couple questions that are coming through. So I think I know where this question's going, but it's not maybe so much about itemizing. But the question is, I need to replace my AC within the next couple of years. How does this bill impact tax credits for energy? So obviously that's a credit. So that's going to be different than what you're referring to on the SALT deduction specifically. But I think what we're seeing, and Matt, you can correct me if I'm wrong, but
Mm-hmm.
so like residential clean energy credits, typically those are it's like capped at 30%. And then but also a dollar amount. Is that right?
Yeah. Typically it's a dollar amount, depends on what it's for. We were doing a case earlier where there was an AC unit, but then there was also a heat
Mm-hmm.
pump. Right. So again, it's there's a really good resource that we use when we're working with our clients' taxes. It's Energy Star. Kind of gives us, because I don't know really besides air conditioning blowing cold air, don't know the
Mm-hmm.
difference between all the different mechanisms and which one is and which one is not. But I don't have to be an AC expert to do that. We have some really great resources that tell us, here's the item, here's what the SEER rating is or whatever it may be, and here's
Yeah.
how it gets then applied to a credit. But I think, John, where you're going with this is there's a phase out that's taking place.
Well, yeah, and I think to add to the answer that you gave, in the situation of an AC unit, I'm almost certain it's 30% capped at 1,200. So it can't go above that number, but if there's a heat pump, it actually increases to something like 2,000.
Yeah.
And the bigger maybe message here as it relates to the question that we're being asked is this going away? And the answer to that, unfortunately, is yes. I mean, part of this big beautiful bill is that energy efficient, home improvements and clean energy, a lot of those credits are expiring. They have different timelines for them expiring. In fact, like if you look at the EV credit for the electronic vehicle credit, that actually ends on 9/30. So like in the next, week or so. But the residential clean energy stuff, that ends on 12/31. Another question, Matt, and then we can move on. Are these deductions that we're referring to, is it 2025, 2026, or both?
Yeah, what we're referring to is both 25, 26, and we'll even extend that out a little bit further, right? It goes all the
Yeah.
way to right now at this point, for the most part, 2028. Coincidentally, what occurs in 2028? It's another presidential election, right? So you kind of look at some of these things that are expiring right at the end of the current president's term, and we'll see where they go after that. I think there's a little bit of political maneuvering there, obviously, but we'll see where that goes after that point. Certainly think it's whoever runs on the next platform will probably try to add to this, and I can understand why politically one would do that. But currently, right now, these are actually going to go through 2028.
Yeah, you're really good about explaining when we do these webinars too, that our job is to be politically agnostic. Like, that's not the objective here, is to give ideas or opinions. It's really more to unpack some of these things. So actually, some
Yeah,
some of these deductions, Matt, are technically set to go, permanent changes. But
yeah,
I think for the senior deduction, which is a big part of the next conversation, as you said, it will be 2028, which I think is a good segue. And one of
yeah,
the main reasons that we decided to do this presentation today is the amount of times, Matt, let me know if I'm cutting in and out. It
yeah.
says my internet's unstable, but it's the amount of times that we've gotten these questions of, hey, listen, I'm reading or I'm hearing that Social Security is not going to be taxed anymore. Does that apply to me? And as you can see here, I'm screen sharing something that, if you look at the timestamp, actually a client forwarded this to me, which was pretty cool. But the timestamp was July 3rd. So it was the evening that this legislative big beautiful bill passed. And it's got a pretty big statement built within this email that came directly from Social Security. And it states that 90% of beneficiaries will no longer be paying federal income taxes on their Social Security benefits. Unfortunately, there's a little bit more than meets the eye to that statement. Because before this legislative change occurred, 64% of Americans were already not paying federal income tax on their Social Security benefit. So if we're kind of keeping score, roughly speaking, there's about 67 million enrollees in Social Security. And our estimates would suggest that about 16 million of them will see a direct benefit of their Social Security tax inclusion change, which is about 24%. So part of the reason these numbers are so skewed is that 42 million are already not paying federal income tax on their Social Security benefit. So the big change, and why we're getting that question, is this senior tax deduction, which basically states if we're over the age of 65, regardless of taking a standard deduction or an itemized deduction, that it's completely irrelevant to that. We'll get an additional tax deduction of $6,000 or $12,000 if we're married filing jointly. But there's a caveat. What about
Always
phase
is,
outs?
John, isn't there? I mean, everything has a caveat to it, right? There's never just everyone's going to get a nice big senior deduction. No, there's going to be a limitation. Always is.
Can you talk about the phase outs?
Yeah, I think am I good to go over on my end, John, or should we just continue talking phase outs? I mean, the phase outs really start, and I think the next slide you have probably illustrates that actually. Phase outs really start at 150,000 married filing jointly,
Mhm.
or 75,000 if you're single. So you see on the left side of your screen there is your income. Right side for single, right side is for married filing jointly. And we had this question. If some of you were on our last webinar, I attempted to address this. We had a client, great client of ours, who's still working, over 65, but spouse is retired, and said, Matt, my goodness, I'm so scared. How do I keep my modified adjusted gross income below 150,000? And I said, hey, listen, one thing you really don't have to worry about is if you go just marginally over that 150. In fact, you'll see on our screen here, you can go as high as either 165 single or 240 if you're married, really 250 married. That the reduction is approximately 6% for every dollar over these thresholds. So someone with $155,000 of income, it's not a line in the sand. You don't lose this deduction, but you'll have a marginal decrease in your additional senior deduction here that I'll kind of illustrate how that works here in a tax return in a moment.
We're getting a good clarifying question, which is what is this income based off of? Is it modified adjusted gross income? Is it taxable income?
Yeah, and this is where, thankfully it's really complex, which is why you need us, right? There's no there's no easy answer to any of these questions. Modified adjusted gross income is really a sort of a catch-all word. Modified adjusted gross income impacts so many different pieces of your tax return. But in this case, we are looking at your modified adjusted gross income, which is for the most part all of your income with some exclusions. And a lot of those exclusions are like foreign income and foreign housing allowances and these sort of like obscure ones. One of the things that is not included is your non-taxable Social Security benefits. So I'm going to show you how that works here in a moment. Maybe explain how Social Security gets taxed and then how this deduction is impacted by that tax.
Before we jump to that, I think that this is a good summary slide. So back to the question that I got, for the deductions, I think this really helps us see what they are. So for a single filer that's over the age of 65 will receive the new $6,000 deduction as long as we're in those, as Matt explained, in those income thresholds.
Yeah, and let me back up for a second. One thing that I forgot to say, John, is both of you, especially if you're married, do not need to be over 65. If one spouse is over 65 and one is under 65, doesn't matter. The one that's over will still get that additional senior deduction. The one under 65 will not get it. But really important point here, especially as you're going through what some of the deductions will look like.
Yeah, that's great. Well, okay, so I'll jump over to married and we'll assume that they're both over 65. We've got 12,000. Then we have the standard deduction of 31,500. And then actually, if you recall, there was an existing already 65 and above deduction of 3,200. So in total, the amount of deduction that can now be applied is 46,700. So, I mean, it is a pretty big swing. At the end of the day, I think what you're about to illustrate is that that's going to impact taxes. The question is, does it impact Social Security inclusion?
Great point. So let's talk about how does this look on a tax return. So on my screen here is our fictitious tax return, right? So we always try to pick a name from The Office. I had the Schrutes here. John had the Halperts on a different one. What doesn't work as well as Michael Scott, because we have an actual Michael Scott, but I did change the spouse's name from Ashley, who's his current spouse, to Holly to just keep this and did put our address here. But
Michael's watching this. This is the biggest eye roll ever that you just got.
He's so annoyed about this. It's why I did it, I think. It's because I could have used so many other the Office show names, but you know what? I'm gonna use his. So here's a 2024 tax return. All right, clients dividends approximately 25,000, IRA distributions 75,000, and now here we have Social Security benefits. This is how Social Security benefits are either taxable or not taxable. We look at this other income. So in this case, the other income is close to $100,000. You'll notice that of the 60,000 of combined Social Security benefits for this couple, 51,000 is included in their taxable income. Now, I'm going to save you from doing the math here because it's pretty simple. If you divide 51,000 into 60,000, you get 85%. And that is the maximum amount anyone can have their Social Security included in their taxable income. And as the lower taxable income you have, less of your Social Security becomes included. Less numbers come over from line 6A over to line 6B. So again, this is 2024. We also have some capital gains here. And we determined that this client has adjusted gross income of $156,000. It's still tax year 2024. The old standard deduction, $32,300. No changes. And the tax bill is right at about $17,000. So a couple points to remember here: the inclusion of Social Security, the adjusted gross income, the deductions, and what the actual tax bill is to the client, $17,000. All right, so let's fast forward our little time machine here where it's now April of 2026, and I'm doing your 2025 tax return right now. I'm getting ready to shoot your video. You'll see all the fun things that I've been saying for the past 8 years on these videos that we do for our clients when we're doing tax returns. Oh, I did change the name of this one.
I wanted to say that, Michael. I think or Matt, what's fun about this is, yeah, you changed it from Michael to Dwight. What's fun about
Yes,
this is that for those, and almost everyone on here has received one of your famous tax videos that you do where you kind of
yes.
walk through it. And so it's cool because like you're using the actual tax. It's like, it's as if I'm watching my tax video
It
that
is.
you'd
I
be.
do about 150 of these during a 3-month period of time. So towards the end there, I start to just slur my words because I have to will myself to do another one. But I know they're so well received by our clients. We'll continue with those. Okay, so here it is. Now it's 2025. Well, it's really 2026. I'm doing the 2025 return. 25,000 of ordinary dividends. IRA distribution 75,000. Look, no change in how Social Security inclusion is calculated. All of this talk John just gave for the past 20 minutes, none of it has changed the way that Social Security gets included in our taxable income. But now let's take a look at page 2 here. Same capital gains, same modified adjusted gross income, 156. They're slightly over the $150,000 mark by about 6,000. So now their new standard deduction, including that senior deduction, is at 45,980. Look at that tax bill, down to 13,006. If you remember a moment ago, it was at 17,000. It was like 16,900 bucks, down to 13,006. It's a $3,500 tax savings. Did we change how
Mhm.
Social Security gets taxed? No. Did we change how Social Security gets included in your taxable income? No. You really received an additional bump in deductions here. And that's the point of this. And if we can control how much taxable income you have, maybe we're adjusting the amount of IRA distributions. Maybe we're determining different places to pull income during retirement. We can keep your modified adjusted gross income in a reasonable range for the most part and allow you to get the maximum amount of deduction and really kind of pay your fair share and not a dime more. So I wanted everyone to see and get rid of all of those misconceptions that are out there. Nothing has changed about Social Security. All that really has occurred is this increase in deductions. But as a byproduct now, less people are paying taxes due to Social Security inclusion. All these different news points came up. But really, at the end of the day, mathematically, the only thing that's changed is an increase in deductions.
Well, and unless your income then fell into the threshold where you did benefit from it, right? So like this is in this hypothetical scenario, which I like because there's certain, there's scenarios where for many of our clients, yes, you get a tax benefit by having an additional standard deduction, but it's not enough to reduce Social Security tax inclusion. But
So,
there are
yeah, so
thresholds, right? So if we're married filing jointly, anything, 44K and below starts to move the needle.
Yeah, so I just threw one last example on here is what happens if we are able to manage the IRA distributions and manage the taxable income. And you'll see here again, reduction in IRA distributions or reduction in total income means that less of the Social Security is being included here. It went from 51,000 to 36,600. You're now eligible for the maximum amount of deductions here. And the tax bill is down to 3,700 bucks. This is what we try to do. Now, it's not perfect. Clients with a pension, clients with only money inside of IRAs and needing income, there's only so much that we can do. But when a client has diversified their taxes, oops, we
I
have
hit a
so
button.
many,
I hit a button.
that's all right. We have so many options at our fingertips from our planning. So that's why we love having money in Roth IRAs. That's why we love having money in non-qualified accounts. And you have money in your IRAs. It gives us, when the time comes to create an investment plan, is to overlay the taxes on top of that. What is oftentimes a senior's largest bill in retirement is their tax bill. Why are we not
Mhm.
focusing more on that to reduce that amount as much as we possibly can within reason and allow you to only pay your fair share? So this is where I spend a lot of my time in your meetings, and you guys see me in those meetings. We'll talk about investments, we talk about Medicare, but taxation for me is an area that it's this puzzle piece. I like putting all the puzzle pieces together. I don't love doing it over a 2-month period of time every year for the last 22 years, but
You
sometimes you sign up.
take that up with the IRS. You could take
If
that up
they
with the
just give me
IRS.
a little bit longer of a window. Actually, no, I say that we have clients that are on this call that taxes are still not done yet because they've extended till October. So maybe it is good having it in a small period of time. But my point here today is to just show you if we can control taxable income, we can control benefits, we can control deductions. And I feel like that's a very important part of anyone's retirement plan. It goes hand in hand with the investments.
Yeah, I mean, I think that's why, that's why I keep referring to it as an indirect benefit to the Social Security tax inclusion issue because you could benefit from it. But either way, as long as you're below that married filing jointly 150 number or, 75 for single, you'll receive that deduction and that will have a benefit. I'm
Yeah.
getting a question that
Yeah, let
it
me
kind of,
answer Lisa's question here.
yeah.
Lisa, I was showing the
Okay.
2024 return, and that was the 32,300. That's if they were 64. So that was the Schrutes or the Scots were 64 last year, turned 65 in tax year 2025. That's why you saw the difference in standard deduction. The point was to illustrate what has changed now that they've turned 65. So the slides were correct. And again, this was just an illustration showing year over year what occurs as clients get older.
Did you figure out your favorite tax credit yet?
My goodness gracious. No, I haven't. I'm still thinking.
You got time. You got a
How
few more
much?
minutes.
All right, good.
So just another question, and we this comes up a lot in the
Oh, I
planning.
just found it. I just got it, John, but I'm not going to say it right now.
You're just gonna leave us hanging? All right, fine,
Yeah,
fine. We'll
I'll
wait till
say
the
it
end.
at the end. Ask me one more time.
So are the rules for required minimum distributions changing at all? And so the short answer to that is no. For those of you that know what this is or are affected by this, I mean every retiree is at a certain age, but at the age of 73, basically it's the IRS saying, "Hey, we've let you put money into an account that you got a tax deduction for, 401ks, IRAs, that type of thing. Now we're going to make you take a portion out every single year so that we can tax you." So the rules around those have not changed. I think what's important and kind of what you were alluding to before of like, how, what are the things, the metrics that we can do to control our income for the folks that are charitably inclined? There are also a lot of rules around qualified charitable distributions, right?
Love QCDs. We just talked about how can we have deductions or how can we reduce the amount of taxable income? How can we reduce our IRA distributions down the road and qualified charitable distributions for those that are tithing to their church or participating in their favorite 501c3 charitable organization and they are over the age of 70 and a half. And maybe if they're 73, they're taking required minimum distributions. QCDs are a fantastic tool that we get to use, and there's maybe about 10% of our clients that probably utilize those. And it's just an adjustment of where you're making your charitable giving from. It's coming from your IRA rather than coming
Hmm.
from the cash in your pocket. For our clients, it shouldn't really matter. It's the same. It's their money overall. It's just the direction where it comes from. But if you recall back to when we were looking at the tax returns, by having less IRA distributions, and whether that be because you've reduced it down because we've had other places to pull from, or you have gifted your IRA distributions because you're over the age of 70 and a half, that is just double counted because you now have less Social Security inclusion and therefore less tax. So QCDs are a really fun one for us. They're very technical. They have to be done in a very specific way. And as long as you follow the rules, they're a fantastic tool for us.
Yeah, well said. And not to go back to it, but I do think that this is a good and powerful visual to try to explain. Like it was nice because you were showing it in real time in a tax return. But just so folks kind of have an idea of how these rules work when it comes to that Social Security tax inclusion number, this is what I was referring to when I said a few minutes ago, like for married filing jointly, 44,000 or below, right, Matt? So it's
Mm-hmm.
basically what I always tell people is when it comes to your benefit, your Social Security benefit, as little as 0% of it could be taxed, and as much as eight could be included in your taxable income, and as much as 85% of it could be included. But for those that are wanting to kind of see how does that actually shake out, I think this is a really powerful visual to help explain that. Matt, I'm going to make a hard pivot to healthcare. Is there anything else on the tax side that you want to
Yes.
touch on?
Okay. My favorite tax credit, really quickly here. This impacts 0% of our attendees, I think, for the most part here. But I'm going to have to go with child tax credit. Raising these kids, it's not cheap, but getting a few extra grand in my pocket every tax, it really offsets some of those costs. So I'm going to go with what probably impacts me and John the most here between the four kids that we have between the two of us is the child tax credit. So that is my favorite tax credit. Continue. Sorry.
It's a good answer. It's a good answer.
Thanks. Very politically.
So obviously, we'd be remiss if we didn't talk about healthcare. I mean, Matt mentioned earlier that taxes is one of the most important things that will impact you in retirement, and it's a very it's one of the biggest expenses that you'll have in retirement. If you think about adding up all the different areas that you get taxed, from property tax to income tax and so on, just behind that is going to be your healthcare costs over the course of your lifetime in your retirement life. And so we do want to touch on this. It's estimated that, so the first one here that you see, the Affordable Care Act, this is going to be for the folks that are retired but not yet 65. And right now, they estimate that 5.5 million adults between 55 and 65 get their insurance through ACA. So the legislation that came through in this bill that passed on July 3rd is that a lot of the enrollment windows will be shortened. They're going to impose new documentations and limitations, really just kind of like tighten up, creating more accountability for enrolling into the plan. And I think it's not so much what's included in the bill, but rather what's been omitted from the bill that I think is really important to know. Because for our retirees that, hey, I retired at 61, now I'm 63, I've got a couple more years until I'm on Medicare at the age of 65, and I'm relying on this tax credit to help offset my premium. At the present moment, those advanced premium tax credits are scheduled to expire on 12/31/2025. So as of the day that we're recording this here in September, they're scheduled to expire. As we know, the government, it could get together in the 11th hour and make changes. And Matt, I think I can tell you chomping at the bit wanting to say something on this matter.
Yeah, this is a
Yeah.
hard one. We really made an like ACA planning, early retirees. You're 63. You don't want to retire because you'll lose your benefits. So you got to keep working. And we finally had like a solve for that, which was the Affordable Care Act and how the the premium credit is calculated. And we really dove hard into this as a firm because we have a lot of early retirees, people who have worked their tails off and have the benefit now of being able to retire at 63 or 64, not quite of age to get on Medicare, where things changed dramatically. And so, we probably have, I don't know, 10 or 15 clients that are on an active ACA plan right now. And, we've always ended with every one of those plans with, hey, this is all great until we see a legislative change. And that's kind of
Mhm.
where we're at the point now. Again, a lot of people are using the Affordable Care Act. I would be very surprised if it did go away, but I'm not going to stake my claim on any of that. Our job is to monitor legislation and make changes as it comes up, just like what we're doing here with the new tax legislation. And we'll
Right.
cross that bridge when we get there on December 31st, if there's going to be a dramatic change when it comes to the Affordable Care Act and how our early retirees are benefiting from the income-based credits.
Yeah. And for those of you that are 65 and above, obviously Medicare is going to be what's on your radar. And actually, I got a message come through the chat about IRMA. So I do have a
Oh
slide on
God,
that. So
Irma
we'll
gives
talk about
me
that.
I have
Hold
PTSD
on.
from
We'll get
anything
there.
called Irma.
We got it. We got it. We'll get there. But as it relates to the bill, I think at the present moment, it does look like there's going to be potential reduced access to providers. So some providers may choose not to accept Medicare due to lowered reimbursement rates, which could affect options for care. It might also increase some out-of-pocket costs. A lot of this is still very uncertain. What I do have a little bit of a confidence in saying is that there's obviously, for those of you who've already gone through this Medicare stuff, you've kind of got two specific choices: going on a supplement plan or going on Medicare Advantage Part C. For those of you that are on the supplement plan, my feeling is you'll probably be less impacted by some of those things, although of course insurance costs always seem to go up, right? They never stay the same or go down, they always go up. I think it might be impacting the folks that are on Medicare Advantage Part C. But we'll talk about that here in a moment on how to just have some more follow up on the Medicare stuff. To the IRMA question, though, I do want to pull this slide up. This is a big deal. It affects a lot of retirees. And to answer the question, which is, are there any changes to IRMA? The answer is functionally no. And basically, that is remaining intact. And how this works is if our modified adjusted gross income is above certain thresholds, then our premiums for Medicare are changed to reflect where our income is. So make no mistake about it, it's a tax. It's just in the form of a premium payment. Did you want to say anything else about IRMA, Matt?
I think IRMA is a really important factor for our clients, especially when I look at it as a tax, right? It's a tax that's not paid on the tax return. It's a tax that's assessed as part of your Medicare premiums. We had a client last year, it was 2 years ago, who sold a whole bunch of double E bonds. We really didn't make us aware of it, right? Hey, Matt, I got a whole bunch of double E bonds. I just sold them all. That pushed her income up into the higher IRMA amount for the given year. Well, it takes 2 years to adjust this number back down. There's ways that we can apply for an appeal for it. But on top of the additional federal income tax is now we have an additional amount per month that is being assigned to the income related monthly adjustment amount. I want to just say that for everyone out there, what IRMA is. It is basically, again, a tax on top of your Medicare premiums, depending on what your adjusted gross income is or modified adjusted gross income is. So very, very important to keep in mind. And it's part of our tax planning is to look at if we're going to make a change income tax wise, not only what does that do to your tax bill, but what does that do to your Medicare premiums? And you can see these numbers are not very pleasant, right? Goes up as high as 628,000. Now you're making 750. So you might be saying, all right, you make 750, you can pay some more. But look at even some of the middle range, especially on a one-off windfall, really becomes impactful. And again, it takes about 2 years for this to drop off. It makes it really difficult.
Yeah, we got a good IRMA question, which is when are the 2026 IRMA brackets typically announced? It's usually in Q4. I usually see it around open enrollment date, which is October 15th. So for context though, it's inflation adjusted. So last year, for example, it was 206 and then it went from 206 to 212. So it's typically a modest increase of modified adjusted gross income. And as Matt alluded to, it's a 2 year look back. Why is it a 2 year look back? Because arguably that's the most recent relevant data that they have on you to fact check what you say your income actually is. So if you're turning 65 in February of 2026, well, it's February of 2026. You haven't even filed your 2025 tax return yet. The earliest thing that they can look at is your 2024 tax return to fact check you. Now, there are things that you can do to qualify out of that if they're reasonable life-changing events like retirement and your income was lowered. And we'll talk all about that. And I think it's a good segue as we're wrapping up. We'll talk all about that on October 15th at noon. We're doing geez Louise, we've done this every year for forever, it seems like, Matt. But every year during open enrollment, we do a Medicare roadmap where we talk about all the plan changes that are forthcoming. Because by that point, typically we know what they're going to be. We don't always know everything. Like they still sometimes don't announce what Part B premiums are going to be yet. So sometimes we don't know everything, but we have a good lay of the land by this point. So I love QR codes, as you can tell. So please scan that QR code.
Break out those iPhones and cell phones to take a quick snapshot of these. And my mother just reminded me, John, she'll be in Paris on October 15th. So just take one away from the RSVP list.
Well, it's okay. We'll send you. We'll send you the recording.
She can, as long as she's got a cell phone signal or a Wi-Fi, she can actually attend this. But beautiful thing is these are not only live, John, right? They're also on demand. And that third column over there is taking a look at our YouTube channel where a lot of these things are replayed. And you can either forward this on to someone who might have some of these similar questions, or if you're too busy and maybe you're in Paris, you can watch the replay on YouTube.
Yeah, we try to share everything, obviously, on other social media platforms like Facebook as well, which a lot of you follow us on. But find us at Candor Path on YouTube. That's where you'll find, especially like a lot, the longer like webinars like this. That's where you'll find those replays. And last but not least, I really want to call attention to the first one, which is Matt's Calendly link. I think this is a big deal. Matt, watching you go through that estimator of here's what taxes looked like last year, here's what they look like this coming year. Matt is kind of currently in that season right now. So tax season's always February, March, and April. And tax pro forma season, which is a fancy term for saying when we do our estimates, is usually in August and September, where we're doing estimates now in the month of September so that we don't have a surprise come April of next year. So my hope and ambition, and I know Matt's and everyone on our team, our ambition is that when you join a webinar like this, if it sparks that question, if you think, oh goodness, we didn't talk about that at the last meeting, and I don't want to wait till the next meeting to talk about that, that's where you can click on, you can highlight that QR code and schedule some time to do some good tax planning with Matthew. Thank you all for joining and hanging with us today. Certainly, it was a big one to try to unpack, what did we say it was, like 870 pages of a bill, but doing our best to hyper focus on our retirees was the ambition for today. Matt, anything you want to wrap on
Yeah, you
as
got
we're
us in
ending?
on a tight 45 minutes here, John.
That's
Dude,
always the goal.
you are the best host of these things. I think Michael and I, we'll have done these together. We'll have a few more guests down the road here that we do this with, but fantastic job hosting us here, keeping us on track. And again, we're here for all of you guys for any other questions, comments, or concerns you have. We love hearing from you guys. So on behalf of myself, Mr. John Kennedy, the rest of our Candor Path team, we love you guys. We're here for you. And if you have any questions, you know how to find us.